The world is on the cusp of a financial revolution, quietly unfolding beneath the radar of mainstream media. While global markets obsess over volatile stocks and interest rates, a seismic shift in the very nature of money is underway. Nations are strategically accumulating gold at an unprecedented pace, challenging the foundational principles of our modern financial system. What if the money in your bank account is merely a promise, and real wealth is returning to its ancient roots? Get ready, because the biggest financial squeeze in history is brewing, and it involves something far more fundamental than you might imagine: gold. For years, the narrative has been that gold is a relic, a dusty antique in the digital age. Yet, behind closed doors, major global powers are treating it as the ultimate financial weapon. China, in particular, has been systematically cornering the gold market, absorbing vast quantities without much fanfare. But it's not just China. India, for instance, holds immense amounts of bullion, predominantly in the form of jewelry, embedded deeply within its culture and economy. Further east, Russia stands as another significant player. We understand, on good authority, that Russia's two sovereign wealth funds combined hold an astonishing 10,000 tons of gold, with the Russian central bank adding another 2,300 tons to its reserves. This appetite for gold extends beyond individual nations. The central banks of the Shanghai Cooperation Organization and BRICS nations are also believed to be hoarding gold, likely through their own sovereign wealth funds. This aggressive accumulation in the East stands in stark contrast to Western markets, where liquidity for physical gold appears increasingly minimal. To understand this strategic pivot, we must revisit the fundamental difference between true money and mere promises. Gold provides final settlement. It's a transfer of value without counterparty risk. This concept dates back to Roman times, specifically 448 BC, when laws were established for metallic settlement, initially using bronze, then later gold, as the accepted unit of value. Contrast this with our modern fiat currencies. Every dollar, euro, or pound is essentially a deferred settlement, a promise to pay backed by nothing more than faith in the issuing government. When confidence in a currency falters, its value inevitably falls. Historically, fiat currencies have a notoriously short lifespan. The US dollar, for example, transitioned to a pure fiat currency in 1971 when its convertibility to gold was suspended, a process that arguably began even earlier in 1933. This history tells us that fiat currencies come and go. The current trajectory of gold, therefore, suggests we are witnessing the twilight of this fiat currency era. China's approach to gold is deeply rooted in a cautious, almost old-fashioned understanding of monetary stability. Unlike Western economies, which embraced Keynesian economics, China maintained a belief that the capitalist system could fail, likely through its currency. This conviction led to a crucial policy decision. Shortly after Mao Zedong's passing, China embarked on a systematic accumulation of gold. In 1983, the People's Bank of China was given the sole responsibility for managing and acquiring the nation's gold and silver reserves. For decades, Chinese citizens were actually prohibited from owning gold. This changed in 2002 when the Shanghai Gold Exchange, SGE, was facilitating the delivery of gold directly to the public. What's particularly intriguing is what happened during the massive gold bear market between 1983 and 2000. During this period, an estimated 10,000 to 14,000 tons of central bank gold from Western nations was out on lease, sold into the market, and never returned. Many believe this gold found its way to China, which was quietly accumulating it. Since the SGE opened, over 27,000 tons of gold have been delivered into private hands in China. This is in addition to China's vast domestic gold mining output, which is now the largest in the world, eclipsing even South Africa. There's a saying that perfectly encapsulates this phenomenon. China is like Hotel California for gold. It can come in, but it can't get out. Adding to this domestic demand, China boasts a household savings rate of over 30%, amounting to an astounding $5 trillion a year. While this money once flowed into real estate, the current economic climate is seeing a significant portion directed towards gold accumulation plans offered by Chinese banks, accessible with as little as 500 yuan. This massive internally driven demand suggests China's total gold holdings, both state and private, could be around 75,000 tons. A staggering figure, especially when considering the global above-ground gold stocks are less than 200,000 tons. Here's where the situation becomes critical for the global financial system. Despite the Eastern gold rush, Western investment portfolios show a strikingly low allocation to gold, less than 0.5% of the estimated $300 trillion in global investment management portfolios. Major U.S. banks like Goldman Sachs, Bank of America, and Citigroup, responsible for managing trillions, likely hold very little physical gold. Now, consider this. If there were to be just a 1% increase in portfolio allocation towards gold across this 300 trillion universe, it would necessitate the purchase of 25,000 tons of gold at current prices. The critical question then becomes, where would this gold come from? The reality is, the current above-ground supply, after accounting for Eastern accumulation, simply isn't there. This immense demand colliding with an illiquid supply is creating what many are calling the most enormous crisis in the gold market. The lack of available physical gold to meet even a slight increase in demand from global portfolios will trigger a massive squeeze on the system. This isn't just about gold prices. It reflects a deep underlying loss of confidence in fiat currencies, causing gold to hurtle up against the dollar. The same illiquidity applies to silver, an essential industrial metal, amplifying the potential for a broad-reaching crisis. The global financial landscape is undergoing a profound transformation. The strategic accumulation of gold by Eastern powers, the inherent fragility of fiat currencies, and the minuscule gold holdings in Western portfolios are converging to create an unprecedented situation. We are heading towards a future where the distinction between a promise to pay and true tangible wealth will become painfully clear. Understanding this dynamic is no longer just for financial experts. It's essential for anyone who seeks to protect their wealth in the years to come.